And most new traders just jump straight into trading. They get an account funded up. They just start buying and selling randomly without much of a plan. I can tell you that is the quickest way to lose all the money in your trading account. But it doesn't have to be this way. There are various other techniques that will help save you money, but also maximize and make the most of the opportunities in your trading when they come along. And that's what I'm going to look at in today's video. It's all about risk management, and if you don't apply these rules, I can tell you you're going to fail. It's as simple as that. And I've got 7 key ones, and we're going to look at those in detail and then summarize them at the end. And then I urge you to add them into your trading plan, because it makes a huge difference to your trading, the psychology of trading, your results. You'll feel a much better trader. So with that, let's dive straight in to the risk management. So first of all, what exactly is risk management? And it is the obvious. It's all about the forecasting and evaluation of, in this instance, financial risks, together with the identification of ways to avoid or minimize their impact. Now, risks can be either thought of as positive, upside risk opportunities, or negative downside threats. And I like to think of risk management as the bigger picture tool, the rules you need to have in place to actually start your trading with. And trade management, that's another video that I'm going to be producing, is the micro management of the trades that you put on. For example, stop loss trailing, stop losses, that sort of thing. And like I said in the intro, we're going to break that down into some key points and then summarize the 7 key rules that you need to be following. So what are the key points? We're going to look at trade sizing, how big should you be on any trade, risk and return, are your strategies good enough, portfolio performance, bleeding to death called the drawdown, scaling up winning home run strategies and getting better portfolio returns, and how do you diversify your portfolio. So let's move on to that first topic. A key rule to start with: before you even start trading, you've got to define these risk management rules. You've got to lay them out, make them part of your trading plan, and you've got to stick to this plan to give your trading ideas the chance to work. You have to be consistent, otherwise you're not going to win at the world of trading. It's as simple as that. So let's start with a scenario. You think oil is going to go up. You've got £100,000, lucky old you, in your trading pot to put on any trades. How much are you going to risk on that trade? How confident are you in the trade? Do you risk 10%, 1%, all of it? Or let's think of it another way. You want success from your trading, but you pick 50% as your answer. Now, if that goes wrong, that £100,000 pot is going to quickly go down to £50,000. You lose twice in a row, it's all gone and you're out the trading game. You've got nothing left to play with. It's back to getting the day job and forgetting about the world of trading. You've got to be cleverer than that. So the question is, how much should you be risking on any one trade? Now, my trade rule here for you guys is anywhere between 1 and 3%. Now think of it this way: if you risk 1% per trade, it's going to give you 100 goes at getting it wrong, and that is statistically, I can tell you, very, very difficult to achieve. And you should also be guided by your trading plan. So if you've got a strategy that works 90% of the time and returns a 2-to-1 risk reward, then obviously scale it up, and we'll look at ways of scaling up those home run trades that break out of that 1 to 3% rule. But for all standard trading, especially if you're new to trading, 1 to 3% to start with. Now, a term you may have come across is the one of risk and reward, and there's actually a ratio for that, and you'll watch a lot of videos on YouTube and they'll be talking about a 1.5 risk and reward trade. What do they actually mean by that? Well, they actually mean for every $100 they risk, they're expecting to make $150. And how do they come up with that equation? Well, there's the inputs in front of you, all very simple. We're going to go more through that when I look at trade management in that video, but we still need to be aware of the risk reward concept because it does play a part at that macro higher level. But if you get the idea that if someone says it's 3-to-1 risk reward, that means for every £300 they're making, they're expecting to lose £100. So you're now probably asking, what is the right risk reward level? And the answer is there is no answer. You're probably thinking, well, I need a really big positive risk reward trade to be a success. And we're going to see how we actually do that analysis and find out those numbers in the trade management video that I mentioned before. But as you get more experienced and understand your trading, and why I say that keeping statistics is key to success, especially as a retail trader, then you can actually run trades and strategies with less than a 1-to-1 ratio. And I'll show you very soon how you can be a successful trader just winning 3 out of 10 trades. But if you've got a low win ratio, then you're going to need a higher risk reward ratio. So that's the play off there. So the higher the win ratio, then the lower the risk reward ratio you need. So going back to that example of only winning 3 out of 10 trades, that means you're losing 70% of your trades. So how can you make money if you lose that many times? Because from my experience, most new traders want to win like 9-10 times out of 10 to make them happy, but you don't need to if you know your statistics. So let's look at an example. So our win ratio is only 30%, but if you win those 3 out of 10 at a 3-to-1 risk reward ratio, that's £300 for the winners, 100 for the losers. So over 10 trades you would have won £900, but you'd have lost £700, and that gives you a net gain of £200. So hopefully there you can see the importance of knowing those statistics and how you'd have to consistently apply them to become a successful winning trader over the longer term. So you've started trading and you're getting a few results in, and you're just wondering, are my strategies, trades good enough? And there's a lot of formulas out there, some taken from the world of gaming theory, that can really help you understand whether you have an edge to your trading or not. And in that red box I explain what the edge is. That's the mathematical statistical advantage you have over the house. In this case, it's the market with your trading strategies, and statistically a 1% edge in the long run means you'll be a winner. And that's how you've got to think. It's like being the casino owner and not the gambler on the floor, because it's the casino owner at the end of the day who's the rich guy. And one of those formulas that you could use possibly is the risk of ruin formula. So don't worry about the formula, it's not all that complicated. You just have to plug in some pretty basic numbers as it explains there. But what I want to take away from this is that the risk of ruin is greatest up front when you start to trade, or if you've got a small trading pot balance, you lack the trading skills, or you trade a long period of time without success. All obvious, I know, but what the takeaway is that these variables go quite hand in hand with your chances of losing your whole trading pot. If you're confused by all that lot, don't worry. Hopefully these 2 examples will make it more clear to you. So let's start with trader A. He's got £50,000 in his trading pot. He risks 10% per trade. He's got a 60% win ratio, and he's going to use 3 capital units, which is basically, once you put it through the big formula that we saw, a 30% risk of ruin. Now look at trader B and the slight subtle difference. Now he is only risking 1% per trade. Now the variables, the inputs are all the same, but look at his chances of risk of ruin, 0.000005214 of 1%. That is so small. The chances of failure just by moving from 10 to 1%, the odds of you keeping that money in your bank account, massively higher by just that subtle risk management trade rule. So you can see what you have to do from those results. You've either got to increase your win-loss ratio or reduce your trade size, and it's like I said and mentioned before, you have to apply this consistently in your trading or you will just fail. Now, performance measurement, as I hope you're starting to see, is critical to your trading success. Knowing your win-loss ratio, your risk return numbers, all very important to plugging into different ratios to tell you whether you are winning or losing. And a very popular measure, especially in the world of hedge funds, is something called the Sharpe ratio. And if you wanted a job in that space, they will often ask you, first of all, what is your Sharpe ratio historically over your portfolio. If you want to get that job, you're going to need a good one, and I'll show you the numbers in a minute. Very simple. It's a one-off number, and that's why I think it's liked so much, and it's very easy to interpret graphically. It can be more advanced than it needs to be, but you can easily build it in a spreadsheet tool, and you can easily, like I say, incorporate that into the world of trading. Now, here's the formula for the Sharpe ratio as you would use maybe in a spreadsheet, the simple formula for it. It's just the average daily profit and loss divided by the standard deviation of that profit and loss times multiplied by the square root of the trading days in that year. So let's look at a spreadsheet example, and hopefully that will make a lot more sense to you. So here it is in a spreadsheet. Take your eyes down to the bottom part where we've got the historical P&L, daily profit and loss. You can see the numbers there in red, and all I've done there is then gone up to the top and created the average daily P&L, which is 722 there, and then worked out the standard deviation of the P&L using a simple formula in Excel. Gives us 2792. Then remember, it's multiplying by the square root, and in this instance I've used 260 because that's 260 trading days in the year, and that's given us a Sharpe ratio of 4.17. But what does that 4.17 exactly tell us? Think of the Sharpe ratio number as the consistency of your P&L going up, say, the side of a mountain slope. The more it deviates from that nice maybe 45-degree slope line of the mountain, then the lower the Sharpe ratio. So the higher the Sharpe ratio you go, basically you're a printer of money. And I have seen Sharpe ratios as high as 20, and they're in the world of algorithmic trading, and really they don't have any drawdowns, any losses. It's just such a nice consistent flow. But not everyone can achieve that 20 ratio. So what are the important numbers to look out for? So if you've got a negative Sharpe ratio, then your strategy just doesn't work. Just give up, don't bother trading. Between 0 and 1, you're going to experience a lot of volatility in your P&L returns, large drawdowns, gains are going to be slow, and if you wanted that hedge fund job, well, you're not going to get it. 1 to 2 starts to be pretty good, and you can make a career out of this strategy. 2 to 5 is very, very good, and you're going to get that job in that hedge fund. Drawdowns won't be as big. That P&L return line is going to be a lot smoother, and like I mentioned before, greater than 5, then keep that strategy you got to yourself, because it's going to be worth something. So like I said, interpreting that number, we've got a 4 result, just over 4 in our spreadsheet data there, so that's very good, and I would be very happy to run that strategy and trade. And you can then start to see, you've back tested the results, or you've done a bit of troll trading for a period of time. If you get these sort of numbers in, it gives you the confidence to know what to do around trade sizing, risk management, trade management, all those variables. And like I said, as a one-off number, is quite a good, useful tool. Now, this is another bit of terminology you may have heard before, the drawdown. What does that mean? Well, think of it as bleeding to death very slowly. You've started with your 10,000 dollar pot, and you're only losing small amounts over a longer period of time. It's not that noticeable, but eventually it catches up with you and you're sitting on a big loss. And a lot of traders will put in a drawdown limit where they will stop and review their whole strategies. I suggest anywhere between 20% and 30% of your initial trading pot. Once a number hits there, and hopefully it never will, but if it does, just stop what you're doing, review, get out your trades, revisit that trading plan, strategies, mental models you have around trading, and virtually you're starting again. But you haven't been wiped out and you've still got money in the bank. Now, we sort of touched on this earlier. It's around that trade sizing concept where I said risk 1 to 3% of your pot on any one trade. What if you do have that, big winning strategy that wins 9 out of 10 and has a good risk reward? Then you want to go bigger with that trade. But how do you actually go bigger? How much should you put on that trade? Now, a lot of people come up with a lot of ideas, and you might hear things like martingale, that type of formula, but I really like this one and use it in my own trading. It's called the Kelly criterion, and it comes from the world of gaming theory. Now, I use it as a guide per strategy and weight that strategy in accordance with the strategy's performance. By the way, if you're interested in learning more about the Kelly criterion, it is a great formula from a guy who liked to clean out the casinos, MIT professor, really clever guy, Kelly, turned it to the world of trading. Well, I've got a video for you there. It can be found under the Ultimate Course playlist as well, but I'll put a link to the end of it if you like to discover, like I say, more about how to use this in your trading. So how does it work and how can we use it? Well, we need a strategy with a positive expectancy, or otherwise trading is pointless, and that's why it's such a good tool. It's going to tell you whether to stop or stay with your trading, and ideally you should be able to back test your data before going live. If you can't, I suggest starting from a point of a 50-50 win-loss, and then as you maybe say give yourself 3 months of trading small size, put those numbers into the formula to see whether your strategy is working or not. But how do we do it? Well, we measure expectancy by the probability of a win times the average win minus probability of loss times the average loss. Now, the Kelly's criterion percentage, isn't that's the percentage number we're looking for, is W minus 1 minus W divided by R. Don't get all flustered by the inputs. It is very simple, as we'll see in a minute with an example. So example 1, we start with a 60% win ratio, and our risk reward, well, it's a 1.5% to 1%, so for every £150 we make, we lose 100. We put those numbers into that formula, and that comes out with a positive 33.3%. So what does that 33.3% mean? Well, you could use it as part of your capital allocation by a particular strategy. That's what I do. So I would say, well, if I've got that strategy, out of my 100% of my £10,000, I'm going to risk 33.3% on that strategy, and accordingly then, break down the trade sizes individually within that strategy. Some who are more risk-takey in their personality might want to use that by the actual individual trade level, but I don't recommend that, and it does take a lot of trading psychology to be able to apply that number in that sort of size. So some people actually divide that 33.3% by 2 or 4 to become more realistic at the trade level, but I like to use it at that portfolio level more. I've included it into the risk management video here. Now let's look at an example where you don't want to be trading. So we've got a 40% win ratio. The risk return is 1.2 to 1. We plug those numbers in, we get minus 10%. So you've got that minus number. Remember going back to even the Sharpe ratio where we looked at the negatives. If we see them, we don't trade. So Kelly's is another way of ascertaining whether your trading strategy is actually good enough in the first place. And as I mentioned before, you can use that positive number, 33.3% different ways. And like I said, some people divide that by 2, 4, 8, depending on their rules in their trading plan. But the key here is to apply it consistently. Don't keep changing between different sizes. If you're going to stick with one method, stick with that method and test it thoroughly and get the results, so you give it a chance to work. So if you got this far in the video, then you're probably saying to yourself, oh really, I've got to only use 1%, I'm not going to make the money that I want to in this trading. The question is, are you risking smaller amounts, and because of that you're not going to be making the big bucks? Well, I'll show you how to get around that, because we want to be risk managed properly, so we feel safe with our trading. We're not going to blow up, lose all our pot, and we want to take that portfolio performance into our overall risk management rule set. And I know it sounds pretty stupid, but one of the key rules of risk management is to be realistic around your expectations and aspirations in trading. If you've got a small pot, don't expect to, with the proper risk rules in place, make huge fortunes very quickly. If you want to ignore risk management, you might get lucky, once in a million shot, but I can tell you most times you're going to lose your pot. And if you made 50 to 100% per year on your pot, that's a very good return. So £1,000 to £1,500, that is very good. And because we've applied the risk rules, we are going to stay in the game, give ourselves a chance of scaling that up and making a lot more in the longer term. So how do we get around that problem of risking smaller amounts but we still want to make more money? Well, one of the secrets to successful and bigger, faster returns is using compounding, and not many people do that or put that into a consistent process within inside their trading plan. And my rule here is, change your position size to reflect the percentage amount of your total portfolio and stick with this process. So if your portfolio, for example, has grown from 10,000 to 20,000 and you risk 1% per trade, then you should have been betting £100 when it was £10,000, and now you scale up to £200 on £20,000, but you're taking no more risk. It's still 1%. And because we keep building up like that, and we know our statistics and our data, we can then start compounding and getting some seriously fast returns. Don't believe me? Well, have a look at this compounding example. Now, it is set in an ideal world, but we start with £10,000 and we make 6% return per month. Trading is not going to look like this unless you've got that high Sharpe ratio that we talked about, but it gives you an idea of how compounding can grow your account. So that £10,000 after 1 year has grown into 20, after 2 it's 40, after 3 81, after 4 150, and then by 5 years we've turned that 10,000 into £329,000. So just using that simple rule of compounding. You may have heard of that saying, don't put all your eggs in one basket, and that's what portfolio diversification is all about. And there are many econometric models and methods that have been put forward to help you in this space: efficient frontier, correlation single index, geometric mean returns, safety first, etc. And I suppose the idea behind it is, if you hold all airline stocks, it's very likely that they're going to move in tandem for good or bad. So maybe you want to break up that portfolio a bit to give you a bit more balance. But remember, when you do that, you're then taking away the possible gains you could make when you create that balance. So there's a fine line to play with, and I like to do it slightly differently. Why do I do things slightly differently? Well, I've studied this a lot as a professional risk manager and trader, and I've seen that correlation amongst assets is very similar. It's very hard to find ones that are doing the opposite or achieve that balance of the basket of trades that you're wanting. And also don't like giving back unnecessary profits. So I use something called preference function, where I'm basically weighing up the performance, the probability of success, my risk appetite against those individual assets, and I scale them up according to how my strategy, my back tests, my results say I should. So really my diversification is I put more into the winners and less into the not so good ones. So I might have all airline stocks, but they're balanced according to their possible potential. So that's just one way of thinking about how to diversify your portfolio. So let's summarize those 7 risk management rules you've got to put into your trading. First one, only risk what you can afford to lose. Define a position size percentage level for your portfolio. Get that drawdown limit in there. Compound your portfolio returns. Build in concepts like risk of ruin, Kelly criterion, Sharpe ratio, portfolio diversification, and then 2 more esoteric type rules. Be realistic, as we talked about, and really it's the consistency of applying these rules is also critical. There's no point jumping from one to the other, changing the numbers all the time, because you win one, you lose one. You're never going to be able to analyse your results properly and see where you're going wrong or going right, for that matter, and then being able to apply those other formulas like the Kelly criterion to find out those winning trades and put more money on them and make even more of a return. Risk management is all about the optimization of the up and the downside, and that's what those 7 rules will hopefully give you. Now, this video on risk management is included in a very important playlist on my channel. As you can see before you, you go to the playlists area, there's one called the Ultimate Free Trading Course, and if you worked your way from the top to the bottom, it's going to cover off pretty much everything you need to know to get you up and running, as a successful trader. And I'm going to add to that list as time goes by to make it even better, even stronger for you. But like I say, the risk management video is in there, along with that Kelly's one that I mentioned, remember. And if you want the shortcuts to them, they're coming up right now.